Cookie, say something quick just so I know it's recording sound.
Can you hear me?
Yeah, that should be good. Yeah, I think you're good, bro.
All right, perfect. All right, awesome. All right, so appreciate you guys all sticking around. I know it's been a long live stream with Crazy PA today, but I think with what I'm about to show you, which is basically a lot of the concepts of the forever model blended with quarterly theory, is going to really help show where price is going and really help everybody to see a lot better. So just first of all, shout out to everybody in Forever Trading Circle, Matt, Nick, Kieran. Of course, everybody's getting all these concepts from ICT, but also a couple of quarterly theory traders that I follow, Bucko as well as Trader Day, who really came up with all the quarterly theory. Bucko is one of the private mentorship students of Trader Day, and you'll find a lot of similarity between this model and what Bucko trades. Without all the extra work of going into explaining everything now, we'll just run through this presentation here. So just a quick disclaimer, obviously it's not financial advice. Trade at your own risk here. Feel free to read through this screen for just a second, but basically with any model that's anybody ever shows you, liability is all on you, right? So, but what I'm going to show throughout this is really going to help everyone to see price much easier where we're heading throughout the day because of its a time-based approach. So really what the purpose behind this model and what I built here is to create a mechanical model to trade the New York Open that gives you clear entry and exit rules. So whether you're a swing trader, intraday scalper, doesn't really matter. This model is fractal, as I'll go on to show. And best thing about it, it's going to remove all the emotional decision making. You'll be able to see price logically, build your own price narrative, and of course you have the benefit of a fractal trade model that you can trade across any time frame and however you would like. I will just give a bit of caution up front. The 1 minute model and the micro cycles that I'll go on to describe for scalpers can be higher risk, of course, because you're trading on the 1 minute time frame. So just take that with a grain of salt and manage your risk appropriately. But it does work, as you'll see. All right, so the foundation for the model is time is always your first factor. So that's how I built this model around quarterly theory and time cycles. So each day can be divided into 4 quarters. Those 4 quarters can be divided into 4 cycles, and then those 4 cycles can each be divided into 4 microcycles. And I'll show you kind of how this works throughout the day. Also the economic calendar, and then I threw in choosing a session here so you have life balance. You're not trading all the time. Try and focus in on one session because it's going to give you the best bang for your buck and your time and allow you to trade with freedom. The second part that you need for this model is your narrative. So we're going to discuss candlestick anatomy, what defines a candle, the open, the high, the low, the close, or open, low, high, close, and how you can use that information to your advantage in building a narrative, as well as external range liquidity to internal range liquidity. You'll notice a lot of similarities here between what Matt trades and what this model does, really helping you to see clear price delivery and where price is heading. And then the quarterly theory concept, AMDX, accumulation, manipulation, distribution, and X, which is either a retracement, a reversal, or a continuation. And then we'll talk about true opens, which is really how you can filter out whether you're in a premium or a discount on the chart. And then, of course, we'll go over all the different steps of the entry model from bias, using the defining range, which is a quarterly theory concept, sequential SMT, true change in the state of delivery, which is a TCISD, where your entries can be, where you should target, and how you can manage your risk throughout the trade. So let's start with time. Time's the most important aspect of the model. Without the right time, price isn't going to move. As you can see, we've been kind of chopping and ranging today as well. But in order to view the chart, I like to view it from a time-based approach. And so there in the gold lettering, you're going to see the time cycle on the left with what narrative time frame you're viewing that cycle on the right. So if you're looking at a monthly chart, that divided by 4 is 4 weeks. What's the time frame alignment for the weekly candle is 4 hours. So that's your narrative. So hopefully that makes sense. It's the same for each cycle as you go down. Weekly cycle, it's divided by 4 days, with the 5th day, Friday, serving its own purpose in the cycle. But the daily time frame alignment is 1 hour. So that's why we look at it from the 1 hour chart. And then so on. Daily cycle divided into 4 is your 6-hour candles. You'll hear that a lot from Matt, Kieran, why they're looking at 6-hour SMT. This is why. That you view on the 15-minute time frame. And the most common chart I take a trade on is the 90-minute cycle or the 5-minute time frame. 90-minute cycle is your daily 6-hour your 6-hour candles from the daily cycle divided into 4 90-minute cycles. And that's viewed on the 5-minute time frame. We'll discuss the microcycle briefly, but I wouldn't recommend starting with that. Stick to the 90 or daily, and you're going to be really good, and you're going to have lots of trades to build from that. So the monthly cycle, when you divide the month by 4, you'll have 4 weeks to it. Sometimes you'll have a 5th week in the month, but that serves its own purpose. Generally speaking, anytime you have a 5th period, whether it's from the weekly cycle or the monthly cycle, it serves its own purpose. And generally speaking, it's either to hit the draw in liquidity or to return to the range if the draw has been hit. Quote unquote, your TGIF setup, right? So monthly cycle breakdown, 4 consecutive weeks, 1, 2, 3, 4, as you see on the chart. This is great for positional or swing traders. How does this cycle begin? It begins when there's a sequential SMT between consecutive weeks. So again, we're viewing this on the 4-hour chart. You'll notice there's a sequential SMT here with YM. What happened after we traded above this down close candle that swept that liquidity there? Well, we traded higher. Pretty simple, right? So your monthly cycle, this will often set the high or low of the month, and your target is going to be the month high or low previous to this. Weekly cycle, which is probably more so for indices traders. You're going to view this on the 1-hour time frame, and this is going to show you Monday, Tuesday, Wednesday, Thursday, and Friday, of course, serving its own purpose. So again, where do we expect that weekly cycle to be put in? Generally speaking, Tuesday or Wednesday. So generally, that's why you're always going to see your highs and lows typically being created on Tuesday or Wednesday because of the weekly cycle. Of course, each day serves its own purpose in the AMDX cycle. So what we're waiting for here is a sequential SMT. As we can see here, we build it in with ES here. What happened immediately once we closed over that? Rapid expansion. So the draw in liquidity is going to be the previous week's high or low. What creates this is whenever we have a true change in state of delivery after that sequential SMT gets put in. And I'll describe this better on another slide and go over that for you. The daily cycle, of course, is your 6-hour candles split out into 4, viewed on the 15-minute time frame, with each cycle serving its own purpose. This is great for intraday trades. Really helps you to see the high or low of the day and helps you to target the previous day high or low. This information is also helpful going into the New York session as well to see if a daily cycle gets put in, then you can expect the next lower cycle to trade from. And I'll show you an example of that as well. The true open for the daily cycle and true open for any cycle is always going to be the opening price of quarter 2 in that particular cycle. This is where you get your midnight opening price from that ICT commonly refers to. It's a time-based premium and discount. So as you can see over here, we had a sequential SMT between the London quarter, which is this 6-hour period, and the New York Q3 quarter, 6-hour period here. Where did it drive up above? The true day open. Sequential SMT, as soon as we close below that, rapid expansion downward. 90-minute cycle, which is my favorite to trade and really where my model is built around, as we'll go on to see. This is that quarterly or daily cycle split into 4 quarters. So I commonly trade the New York AM cycle, the 90-minute, and this would be basically Q3 stacked on Q3 of the daily cycle. So that's why it's higher probability, and a lot of traders love the New York Open session. The true open for this is the opening price of quarter two, which would be 7:30 a.m. And same thing, same principle, right? As soon as we have that sequential SMT, this one was set in between Q2 and Q3. It came and ran up above on YM, above the true New York open and the true day open, so stacked true opens. And what happens? Rapid expansion afterwards. So you can see this is the same trade from the previous slide. So it's fractal, and you can see these cycles stacked on top of each other. And don't worry, you guys will get a copy of this PDF as well at the end, so you'll have all this information too. Microcycle, we won't go into too much detail, but just know that it's viewed on the 1 minute chart. It's a little bit difficult to see on the higher time frame candles because it's a 22.5 minute period. So typically most indicators will mark this out every 22 or 23 minutes. But this is really great for scalps returning back into the range, or just little continuations and microcycles off of a higher time frame. Don't typically encourage trading this until you get more advanced, but it can be quite profitable as well. So our economic calendar is the next piece of time that we have to consider, because this is where you're going to be able to anticipate highs or lows forming within the week, especially around high impact news. For example, on Wednesday, we can anticipate the high of the week to be set on CPI day. And you see the chart, Wednesday set in that high, and then what happens after that, we don't. And this works as well with other high impact news throughout the week when there's not CPI, FOMC, or NFP as well. So obviously some information here about picking a trading session, and this is valuable. You'll hear Nick, Matt talk about it. Kieran, pick a session, pick a pair, focus on those and master them. And that's really where you're going to start to see your consistency come in. And so here's just a little bit of information about this model, how to pick one, and what works for you and what works where. The second piece of the model is the narrative. This is basically the structure that confirms what time is doing, right? So we can't have one without the other. We use them in combination. So we'll talk about candlestick anatomy first and why open high-low close is important. Because basically what we want to avoid is trading in chop, right? A candle that's going to expand, generally speaking, has a very small wick. So that's generally where we want to get in and position ourselves, is somewhere within this wick or at the early part of the body. And a lot of times you'll see on these cycles that form, perhaps like, for example, after the 9:30 open, and we're catching the whole 10 a.m. distribution candle, that 4-hour candle. So open, low, high, close, for example, or open low, or open high, low, close. So our goal is to position ourselves within this wick, which commonly you'll see these wicks form, and they'll go down and they'll touch the TCISD candle and then just rip. So I'll show you a few examples of that. And same thing for open high-low close for a bearish candle. You can see the anatomy of the candle. This is where we really want to be trading in. We want to be able to catch this, but we want to enter and position ourselves somewhere up in here. ERL to IRL, of course, this is the basis for Matt's model as well. Internal range liquidity to external. As you can see here, we formed the fair value gap, which is your internal range. What happens? We come back up with this candle, tag the internal range. Where do we go to deliver to the external? So building this in combination with candle closures can really help you to determine your bias each day, which we'll cover in more detail later. So how does this look with AMDX? Well, also known as the power of 3. Our goal is really to skip trading accumulation because we don't want to get stopped out. We want to wait for manipulation to occur. So really, if anything in the market, what you really need to get good at viewing is manipulation. If you can spot which quarter has manipulated, then the following quarter you can always catch distribution because you already know where the candle is heading. So rather than trying to predict, okay, what's going to happen over here in this quarter or what's going to happen when we hit this high or low, just focus on recognizing when manipulation occurs and trading away from manipulation. We'll talk about true opens. As we mentioned before, it's always the opening price of quarter 2 of whichever cycle that you're viewing. So if it's the weekly cycle, it's the opening price of quarter 2 or Tuesday's candle. If you're looking at the daily cycle, that 15-minute time frame, it's the midnight opening price. If you're looking at New York AM, it's 7:30 AM Eastern Time, all times in Eastern Time. So why is this important? Well, this is a premium and discount filter. If we're above the true open, we should be looking for price to go down. If we're below the true open, we should be looking for price to go up. So you can see an example here from the weekly cycle. We have manipulation below the true week open. And what happens as soon as we close above the down close candle that took that low, we tagged it and expanded. Same thing can be applied for stacked true opens. This is a nice little gem to have. If you're bearish, you're looking for the lower true open to be above the higher time frame true open, such as this case. And if you're bullish, I'm sorry, the case here is bullish, higher time frame, so you have the true week open is above the true day open. Our manipulation occurred there on that lower time frame, and then of course rapid expansion afterwards. So we'll talk about the model briefly as well. Basically, our bias is going to be based on candle closures and defining what our draw on liquidity is. Our defining range, which we'll describe here shortly, but basically that's the last 2/3 of quarter 1 of any period. That's the area that we're looking at to define our manipulation. We require sequential SMT, which is an SMT between 2 consecutive candles in a quarter. And then our true change in the state of delivery, which is our candle where we'll enter on and confirm that sequential SMT has finished. So let's talk about bias for a second. So bias based on candle closures is very easy. As we can see here, this candle took this candle's high, closed back in the range. What can we expect for the next day? An open high, low close candle. As you can see, we get that here. How can we determine that we're still bearish? Well, we close below this candle's low. As soon as that happens, our next candle, we're expecting it to open, put in a high, but also take this candle's low. So as soon as that takes that candle's low, we're done for the day, right? Because now we're building an FVG, right? What happens the following day? We come up, take this candle's high. Why? Because we took this candle's low, closed back in the range. Now we can frame our IRL to ERL, and here's our trade. We come up, take that candle, close in the range. Where are we going? This candle's low, likely this candle's low as well, and that's what happens. Very simple way to get your bias throughout the day, just based on candle closures. This is also fractal. You can use this with the 6-hour candles, the 4-hour candles to help give you bias intraday. So let's talk about the defining range, which is abbreviated DFR. Basically, it's just project a standard deviation from the highest high and the lowest low of the final 2/3 of quarter 1 of any cycle. So for example, here's quarter 1. You can see where the standard deviations are being marked out from. The area where you're looking for manipulation, high probability will occur between 0 and 0.5, up to 1.5. But if you see manipulation occur in the 0 to 0.5, that's usually very high probability. If it happens in conjunction with news, even higher probability that will work out in your favor. If this is where your manipulation occurs, the 0 to 1.5, then your common level that it'll distribute to is the retracement zone, which is on the opposite side of the defining range at 2 to 2.5. And that's exactly what we saw here. As soon as price tagged that, that's where it ended for the day. And this happens over and over and over again. Sequential SMT again takes place when the previous quarter high or low is taken, but it fails to do so on another asset. So here's several examples of it. These are the quarter periods, as you can see, marked out by the indicator. Of course, as we mentioned before, sequential SMT created by a news event is higher probability. So let's talk about the true change in the state of delivery. Which candle is it? Matt had a statement in his workshop video that really sent me down this rabbit hole of looking at time. It's when he said that the candle that takes a short-term higher low and creates SMT, as soon as it closes above it, that's your order block. I went down the rabbit hole of how could we further define that with time, and here it is. It's with this model. It's actually that one specific candle, and that's the only one that I use now to determine whether that's the order block or not. So in this particular example, you'll see that over here on YM, this is the candle that took the low from the previous quarter. It's a bearish candle, so that qualifies as our TCISD candle, right? So this is the candle that creates sequential SMT. I'm waiting, so even if price comes down further, I'm waiting for price to close above this candle. As soon as it does, I mark that out. That's my entry, and that's where we're going. As long as this manipulation occurred below the true open for that quarter or that cycle, I'm good to go. So you want a bearish candle for a bullish setup, and you want a bullish candle, right, for a bearish setup. Now, what happens if this particular candle here was a bearish candle? Then I just simply take the next closest candle to the left that is a bullish, and then that would be my TCISD. We'll show an example of this. Same for this. If this was a bullish candle, then this would be my TCISD candle. It's the next candle to the left that does qualify. So where can our entries go? My favorite is on the retest of the TCISD. This is similar to Matt's model. It's right off the order block, right? As soon as price closes above that, what happens? We tag it here, this down close candle, and immediately we fire off. But you could also use an IFVG or an FVG entry, such as over here. As soon as this candle closed above, now there's your entry. There you go. Same with the breaker. Obviously, you're getting extra confirmation at the cost of increased risk, right? So form it however you like it, but my preference is to use it right off the TCISD, similar to the forever model. Where does our take profit go? Static R, I typically either target 2 or 3R, which is easily achievable with this model, because basically as long as I can get 2R from where the manipulation occurred to the next quarter's high, I'll take that trade. But commonly you can also target the 2 to 2.5 standard deviations as well, because that's where price is heading. It's just a longer hold. You're risking perhaps price not reaching that far. A lot of different news can happen these days. One Trump tweet can wreck your trade, but typically these trades will play out very, very commonly to that 2 to 2.5. And also, when you are trading them, which asset do you want to trade on? Always trade on the bullish asset that creates the bullish SMT, right? I want to trade this one. I don't want to be trading the one that made the low, right, for a bullish. I want to short the one that makes the lower high, right? Same concept. So here's a little bit of data. I'll zoom in on this for just a moment. Special thanks to Jack from Nick's mentorship, helped me to put some of this data together and go through just the last 2 months of data. If you were just to trade the model I'm about to show you, you would have been up 16R just from January and February, with 2 losses and 1 break even. So here's the data. You can go back and look in your chart as well if you like to take a look at it. You'll get this as well, so you'll be able to see it and go back and look at it. But the model I show you, very easy, repeatable, mechanical, and has very good performance in the mix of this choppy PA. So when PA starts to really trend, this model gets even better. So I think everyone will really like it, but it also shows you where price is going. And I'll do a little bit of a breakdown too. So ultimately though, let me stop this and redo here. Okay, maybe not. we'll just continue on. So obviously risk, you really only need a lower size win rate to really be profitable. Everybody knows that. Just stop over trading. Aim to be consistent, spot the manipulation, and trade away from it. And you're going to see your curve, your equity curve go up. So a little bit of information about that here and some summary and key takeaways of the model here. So the strength here is that it's a systematic mechanical approach. Eliminates your emotional decision making. You're going to be able to just execute the trade knowing that the probabilities will play out for you. Easily build your price narrative. You're looking at price logically through time cycles. You're building that structure behind it automatically. And you're able to adapt to changing market conditions because of your fractal model with a clear execution workflow. So a couple of the gems here. High probability manipulation or sequential SMT occurs at the 0 to 0.5 standard deviation of the DFR or the defining range. If that occurs, high probability distribution, usually price ends up at that 2 to 2.5 standard deviations from the defining range. SMT created by a news event is higher probability. And then, of course, there's continuation time cycles, which are higher probability. If you have those stacked true opens we talked about, it's higher probability. And if you have a stacked defining range, I'll show you an example of that last week as well. That's even more higher probability as well for that trade to work. But ultimately, through this quote in here, it doesn't matter what model you trade. If you don't build a plan and you don't have the discipline to follow it, you're basically going nowhere anyways. So let's jump into the chart and see just some examples from last week that played out very well for us. I'm going to throw YM on here. So last week was chaotic with this huge bullish candle that just came out of nowhere after a tweet. Obviously, there was market manipulation in there. But I want to draw your attention to what happened here between Tuesday and Wednesday and why that's important and what happened here. Let me just jump into replay here. So as you see here, YM took Tuesday's high at 4 a.m. on the hourly chart. So we're looking at the weekly cycle. So what can I expect once we close below this candle? So this won't be our TCISD candle, remember, because it doesn't qualify as a bullish candle. It must be the TCISD, so we mark out 3 a.m. over here. This would be our TCISD. Same concept over here. I mark out the same candle that took the high. Whichever candle takes it first, that's your candle you're watching. That's the candle that created the sequential SMT. 4 a.m., it's an up close candle. That's my TCISD candle. As soon as we close below, I can actually enter this trade. Now, a lot of people would say, well, look at the chop. This is risky. Well, if you trust the weekly cycles and these quarterly time periods, you'll see that they play out more often than not. If you're trading this, I want to be trading the asset that's showing weakness for short. So I would short NQ and I would be longing YM over here if that was the case. But you'll see the trade plays out on both ends. Your stop will always go at the high that's created after the sequential SMT. So in this case, this is the highest high after this SMT was created. This would be my stop right here. Very similar setup to the forever model, right? I would enter once this down close candle closed below. And yeah, you're in a lot of drawdown here, but you'll see this is also fractal as well. But what happens after this? Let me just play it out. Well, we don't need to guess what happens immediately. You can see that's 500 something points just down to this first low down here. So obviously this is the benefit of hindsight, but you can see the model works just with that. And also this over here also eventually trades lower as well. Now, This is a little bit riskier setup, right? Because it didn't actually manipulate the defining range. Why is that? It's because of this big up close candle here that wrecked the market this week. But if you look at another example from the week prior, and this is the model that I trade more specifically, is right here. We come up and we manipulate and have a sequential SMT above the defining range, the last 2/3 of quarter one. What happens after this close, or this candle gets closed below? It'd be this one, because this is the first candle that took the high, created a sequential SMT. This candle trades above the high. As soon as we get closure below, price dumps. Same thing over here. Closure below this candle that created the sequential SMT on NQ, dumps. But this can also be fractal, right? So let's take this as an example, right? If I switch to the daily cycle, the cycle below, what happens here? When we come into the New York session with the daily cycle, what did it manipulate? The defining range. As soon as that gets manipulated, here's the standard deviations that project off the defining range. So I'm looking for manipulation between 0 and 1.5. That's where the sequential SMT occurred. I'm going to take the candle that creates it, which would be this one. And since this made the high, I want to short NASDAQ because YM is a stronger asset. So if you see over here, it doesn't matter if NQ doesn't come up into the defining range because it already did it on YM. It would be this candle, and you'd be shorting NASDAQ. Now, what happens if you don't catch the NASDAQ? Well, you could trade ES as well, since it would be in the middle, and it should follow NQ. Here's your trade. This is off the daily cycle. Same principle, right? Made the lower high, it's weaker. And where did it react from afterwards? 2 to 2.5. Notice the reaction as soon as it touched that zone, immediate pullback. That's why these standard deviations are so sensitive. But I actually took this trade live, called it out, and I think I posted it in the chat as well for everyone to see last week. So, but very little drawdown as well. You'll see there's also a lot of other confluences here. Order block was created, inverse fair value gap, balance price range, a lot of different things here. Of course, as soon as we tag it right here, price just immediately melts. That was a nice 3-hour trade from last week. But this is also fractal, right? So we can come down to the 90-minute cycle. And same principle applies, right? Because what also occurred here? A 90-minute sequential SMT. So if I jump on NQ over here, obviously the weaker asset, what did it manipulate? Defining range. Same thing over and over and over again. So when you see all these stacked together like this, you can anticipate a large move. Of course, this one ran all the way down to 4 standard deviations because of that. But same concept, right? As soon as that candle gets closed below, rapid expansion downwards. Or bullish, same thing, just flip it. And so I would like to be out of the trade at the 2 to 2.5. And that's just kind of my easy target. When this 2 to 2.5 lines up with any liquidity to the left, it makes it very high probability as well. So if there's a fair value gap over there or previous day high or low, just know that's going to be the trade of the day. So my model specifically is to trade this right here, this 90-minute model. So every morning when I walk into price, what am I looking for? What day is this? Thursday. I jump on the daily chart. That's my first thing I do. And I look at the prior day. What happened? This is the day we're currently in. Prior day took the high, closed back in the range. For the following day, I'm bearish based on that candle closure. What also happened here? We had that weekly cycle put in, sequential SMT at the highs. So now I have two factors confirming that I'm bearish the following day. Not only that, but on YM, I have my narrative, right? Where did that occur at? Inside of a higher time frame fair value gap. Just like Matt would draw out, right? As soon as that occurs, I'm looking at my 90-minute cycle in quarter 3, which is the New York Open. And all I'm waiting for is a sequential SMT either between Q1, Q2, or Q2 and Q3 of the 90-minute cycle that manipulates the defining range in line with my bias. So I'm ignoring all these bullish sequential SMTs, right? Because overall for the day, I'm bearish. I'm not bullish. Once I get the cycle that matters to me, when did it happen? Shortly after 10 a.m. So now I can expect the 10 a.m. candle to be an open, high, low close. Very simple. Manipulated the defining range over here within 0 to 1.5. Where can I safely target? 2 to 2.5 on the asset that makes the lower high. As soon as this gets closed below, I can start my trade. Stop goes at the high. Target a static 2R for me. And just let it play out. Hold a runner if you want to, whatever you want to do, whatever floats your boat. Doesn't matter. So this model has performed well, even throughout all of the chop that we're doing, just because it's taking into account price movement based on time, where liquidity sits based on time, and how time is manipulating the chart. So that's the model in a nutshell. My favorite is this 90-minute cycle. Starting at 9 a.m. is when I start to get on the chart and watch price. I wait for this defining range to get manipulated in line with my bias. I take that trade every time. So hopefully that made sense to everyone. No, there's probably going to be some questions. So if there is, just feel free to fire away in the chat. It'll take a few minutes to answer a few of them. And I know that's a lot of information just thrown at you, but I'll throw in the, I'll put it in the trading room chat, the PDF of the presentation, so you'll have all that as well. But ultimately, this model is really fire. I think everyone's really going to like it, but it's also really easy to see where price is going and to catch, you know, a nice long or short right before the open, and that just bangs you out, and you're in and out in minutes sometimes. Even today was an example of that. I didn't cover this particular concept today, but same thing applies to today's price action. There's what's called a hidden sequential SMT, which is whenever one asset fails to close above the highs of another. And right here, NQ failed to close above the previous quarter high, which you can see there. This out as a hitting. So you guys can see that. That was your cue right there to short this morning. And YM closed above, as you can see. Rapid expansion once that sequential SMT was formed. As soon as we got closure below here, first candle, first up close candle before the high was taken over here. As soon as we close below, you could have taken that breaker short. If you caught this one, that's great. You would have made quite a bit really easily there. Probably would have just had to mark it in here. Stop at the high. Target the defining range low, 2 to 2.5. When you have a large range like this, it can be difficult to really reach 2 to 2.5. But even just to the low here that was made is almost 4.5 R's. So, and yes, there is an indicator to map. RT asked to map the setups right. Yes, there is. I use these two. Pop the name up here. I use this one to mark out sequential SMT for me. And then I use this one for the dividers for the cycles. These are the same ones I posted before in the channel with the little video screenshots, how to set all the settings that I have. I'll throw those back in there too so you can have them fresh. So daily 6 hour, 90 minute. Yeah, so if you want to stack the cycles up, right? So when I come in for the morning and I see that all assets here traded above the previous daily cycle, which is the London high, I know I can't get a daily cycle and all assets closed above. So what am I looking for next? I'm dropping down to the 90-minute cycle. So I just continue to drop until I find my trade. When you get down to 90-minute and everything else is exhausted, just know that's higher risk, lower probability for the day, but same thing applies. But yes, I use the daily candle for my bias, 6 hour candle for daily cycles for bias as well, and then of course the 90-minute cycle to catch my trade most commonly. If the previous day candle was indecisive, then how do you approach the following day with your model? I continue to follow my bias from the previous day. That's what I do personally, unless we've hit some sort of form of liquidity like here, right? For example, this day looks like indecision, right? But really, we did have a sequential SMT. You can also just sit on your hands, right? Another method, generally speaking, that SMT that gets put in at 9:30 is going to be one to trust, right? In line with news. So if you had 8:30 news that manipulated, what can you expect 9:30 to be? The distribution to the draw on liquidity, right? And then once that gets hit, different things can happen. Tuned in late, what's the defining range? The defining range is the last 2/3 of quarter one of whichever cycle you're looking at. Mark the lowest low and the highest high of that quarter. And that could be different for the daily cycle, weekly cycle. It's all Q1 of each of those cycles. And yes, that's how I frame my bias and draw high or low. And really, I'm just aiming for example, in this, right? What would I be aiming for here? Just previous day low or this external low, right? Or a static 2R. Because once, say, for example, this gets taken right here, this previous day low, right? So this candle opens, puts in a little high and starts to trade lower. As soon as that happens, you've already taken previous day low, right? So you could also reverse from there. So it's just an area that you need to be cautious from as well. Can still get to the Asia lows today. Yeah, I can. Do you always wait until 9:30 to find SSMT? Yes and no, Raphael. So what I'm looking for is also what sequential SMT was formed either in Asia or London, right? So for example, here, there was no sequential SMT on the daily cycle. So where was SMT formed? If you look at the 90-minute cycle, here's a crazy long that you could have caught if you were trading Asia. Are we at our higher time frame key level? Yes. Did we manipulate Q1? Yes. Here's the sequential SMT. This is the candle that did it. This would be your long as soon as it's closed above. This would be your long. Stop goes at the low. Where did it reach? 2 to 2.5. It'd be just a nice mechanical target. What happened at this area? Start to see the rejection from there. That was 240 points from Asia. So there you go. But what I also do is I look to see, okay, did London already manipulate on the daily cycle? Did it already manipulate the Asia low from Q1? If it did, then I know in Q3 during New York, I'm no longer most likely looking for another daily cycle to form. I'm now looking for a 90-minute cycle to form and then trade it in continuation. So hopefully that helps answer your question, Raphael. And it also depends on news timings as well. So you have to take that into consideration of which sequential SMT is going to hold based on, do we have news? Did we close above or below the TCISD and so forth? It looks like Jack threw the indicators into the chat as well. So if you want to pick those up, those are both free to use. And I'll drop my specific settings that I use into the trading channel as well. That way everybody can copy those and your chart will look just like this. The only thing that you have to mark out manually is the TCISD candles. That's the only thing you'll have to mark out yourself. So just to recap on that, the TCISD will always be a down close candle for a bullish setup that takes the low. So in this particular case on NQ, which candle traded below the London low and touched it first? Just mark it out. I have a little bar that indicates that for me, as you'll see the previous quarter high and low as the quarters progress. So this would be the candle that did it. So this would be your true change in the state of delivery once we closed above that. You'll see price starting to react from that. I trade those in line with my bias. So since I'm bearish today, I'm not looking to take a bullish setup. If that makes sense. I'd much rather wait to the following day to do that, if that's the case, and rely on the candle closure from that day to indicate that we just put in a reversal. It's a much safer method. Now, what if the TCISD candle is too wide? So for the candle behind. Yeah, so let's say you have, like in this case, it's a huge candle, right? I think Matt mentioned at one time in his workshop video, I think, I want fun size. I don't want a candle that's like this, right? Because how can I trade off of this? That candle alone, like let's say this was my TCISD candle, right? This candle alone from closure to the low is 134 points. That's way too big of a stop, right? So I don't want to use that candle. I'd rather just wait for another setup or wait for this trade to start playing out and then take a continuation of it, right? Further down the line once another cycle begins. Otherwise, you're risking too much. If that makes sense. But yeah, that's a great question. I mean, it's not that you can't do it. It's just know that definitely size down in proportion to that stop loss size. So you're not risking as many contracts. So your risk remains the same. But also you need to factor in, if you do that, the time of day that the setup occurs. For example, if this is the candle and it's 11 o'clock, 12 o'clock, I'm probably not going to want to have that as my stop because I only got a few hours left in the day in order to make 300-point drop. That makes sense. So it's unlikely you get that big of a move. That's an entire day's range on the NASDAQ, right? So I don't want to take that size. It just doesn't make sense. All right. I think that's everyone's questions. Of course, feel free to drop more questions in the trading chat outside of the stage here if you want. I'll try to get to them today as I can. But that's my model in a nutshell. It's been very, very effective. Several others have started to trade it as well as I've shown it. So feel free to copy it. But shout out goes to all the guys here in Forever Trading Circle because they've helped me to be able to see price this way. With a little bit of hard work, becoming consistent and profitable, and has helped change things for me. So hopefully all this information helps clear the charts up for you guys and helps you to see price in a whole different way as well. Kieran, if you don't mind, we can stop the recording there.
Sweet, bro. I like that.